Hello, this is Chuck Stull looking at the dynamics of competition. We've been talking a lot about market structure, market concentration, but that looks at a particular moment in time. Is a particular market concentrated or unconcentrated? Another consideration is how market shares change over time. So, is there a stable oligopoly? For instance, Coke and Pepsi dominated the soft drink industry for decades and continue to dominate it. Or can incumbents be displaced? If we look at cell phone systems, Research in Motions, the maker of BlackBerry, dominated cell phones in the 2000s, but of course have since been displaced by iPhone and Android systems. So entry is seen as the ultimate check on power. If a monopoly or an oligopoly raises prices and entry is free, in the long run, prices will fall to a competitive level. Similarly, if firms have elevated cost or poor management, the exit efficiency that we've talked about, new, more efficient firms will replace them. And the same is true with poor quality and poor service. If entrants can better serve customers, they will take that business. And we certainly saw in the US auto industry how entry has transformed that industry. Now, the most extreme case of instant entry, a monopoly would have no power at all. And that's the theory of contestable markets. And this became popular in the 1980s with the work of William Baumol. And the idea here was that even monopolies couldn't charge an elevated price if entry was 100% free. And this was very influential during the deregulatory period as we went from having regulated industries to unregulated industries. So the basic idea is if there were no barriers to entry, any price elevation in high profit would immediately attract an entrant with lower prices. So to avoid displacement, monopolies would charge competitive prices even with no other firms currently in the market. Now, this was applied to a wide variety of regulated industries, including phone and cable TV, but on the surface, the ideas were best suited to the airline industry. Planes are not locked into particular city pairs. They can be reassigned to fly to different cities. So the capital is not sunk at all. It can move freely to new markets. So if monopoly prices existed between Chicago and Detroit, another airline could reroute a plane and compete. So contestable markets theory was very straightforward but extreme. Essentially, in order for that to work, entry would have to happen faster than the incumbent firms could change their prices. And that was not very realistic. But the contestable markets theory does raise some important questions. How easy is it to enter, or what prevents free entry? And that's the idea of barriers to entry. How difficult is it to enter a new market? And there's many different types of barriers that could prevent firms from entering a market. Some are legal restrictions, perhaps licensing, patents, um, trade secrets. There may be information problems, not knowing how profitable an industry actually is. It could be that the ownership of critical resources is already locked up, making it difficult for new companies to come in. Capital markets may not be perfect, in which case it would be difficult to borrow the money needed to enter. Sometimes firms may need to sink costs, meaning that if they left the industry, that they would lose that money, and so that would be an exit barrier. And if there are exit barriers, you're going to be careful about entry because you don't want to end up losing that money. And a final barrier is strategic behavior. Incumbent firms could react to entrants in an aggressive way. And we'd seen some of that early in the um, antitrust era. But predatory pricing, limit pricing, or excess capacity could uh, all be ways to limit entrants. Now, if we look at the actual conditions in the airline industry, it turned out to be much less contestable than some economists believed. And the barriers to entry there turned out to be the takeoff slots. At a busy airport, it's a capacity constraint, and you need a slot to fly. and these are all allocated or were all allocated to the existing airlines. The second part were the physical gates and the terminal facilities. These were also allocated or owned by dominant carriers. So actual entry, even in the industry where it seemed most contestable, turned out to be less than anticipated. There was also, in some cases, some strategic response by incumbent airlines retaliating against entrants. If we move to the even longer run, technological change is an enormously important factor. New technologies can disrupt concentrated markets. If we look to cameras, for the film era, Kodak dominated the US industry for nearly 100 years, with only a small amount of competition coming from Fujifilm at the end of the 20th century. Um, so, with limited competition, Kodak was able to charge high prices for its film and earn high profits. Now, of course, digital imaging, digital cameras, and now cameras in phones have replaced film for most users, and Kodak's fortunes have suffered. Schumpeter is an economist associated with the idea of creative destruction, and that is that technological change is more important than the short run pricing problems. Schumpeter would worry less about antitrust and more about innovation. Now, an important question here is, are firms with market power more or less technologically progressive? Schumpeter thought monopoly would lead to more technological change, but the evidence is mixed. Big profitable firms may have the money for research, but they may not have the incentive to implement innovation. And we saw some of that in the auto industry. In some cases, dominant firms may be able to suppress new technologies and prevent new competitors. Some industries, particularly regulated industries, were able to delay effective competition for decades or to control their competition, as the railroad industry did with trucking and the phone industry did with cell phones. So there have been a lot of government policies to encourage innovation, recognizing its importance for um, economic growth and economic advance in the long run. So there are whole areas of intellectual property, patents, copyrights, that are explicitly designed to reward new ideas and creative works. And we'll be discussing those as we get into some of our next industries. There are also some exemptions um, from antitrust for joint ventures, so research and development cooperation between competitors is permitted, uh, again, because the innovation is seen as more important than the competition at that particular point. And of course, governments also provide grants and subsidies to universities to do independent research, to selected industries where they think there is a worthwhile return on investment, and they also have broad tax breaks for research and development, which can promote innovation as well. This has been Chuck Stull from Kalamazoo College talking about the dynamics of competition.